Hey, welcome back to Money Matters, episode 31 with Matt and Rich.
Yes.
How are you, Matt?
I'm great, Rich. How are you?
Awesome.
Yeah.
Glad to be here.
Yeah. We got a nice packed agenda today.
Yeah, we
more
got
than one topic. I like it.
I know. We got the Fed rate rise or potential rate rise.
Yep.
But likely that meeting's today.
Yep.
Powell will talk
2
at
hours.
2:30. Yeah. So we'll see what comes of that. Some zero down programs and maybe some insights on the spring market.
Yes. So it's good. There'll be a lot on the agenda. The Fed talk may seem overwhelming at times when we go through it, but I think it's super crucial for people to understand. Just see what's happening there. And then, like Rich said, we have a 0% down program through FHA. So, something,
awesome.
Something different. They rolled it out probably like a month ago or a month and a half ago, maybe. It could have been sooner. That's when we went over the CMGs, and that's when we got it. I haven't utilized it yet because I don't think a lot of people understand how it's working.
Or even know about it.
Really even know about it. Yeah.
You got a comment this morning. I saw that comment for your on our last reel. Our last episode. That was great. So people don't know about these certain things.
Right.
5% down. Wow.
Right, exactly.
What?
Exactly.
Multifamily?
So when we talk about the Fed rates, that's like a foreign word, I feel like, for a lot of people. And to really, I guess, umbrella definition of it, it's the money that lenders are essentially borrowing from the government. That's what their government's expected to be paid back at. So when for instance, car dealers are a really, really good example for it, right? Car dealers, they have their Fed rate, then they obviously have their little bump in it as well.
Their margin, yeah.
Right. And whether you go to a credit union or anything like that, they have the same exact thing. It's just how much margin they have in it. That really is what differentiates rates. So when those go up, when the Fed rate goes up, those car rates, credit cards, that's why those directly correlate.
Yep,
because
margins go up. Right?
Because of that. Mm-hmm. Right. So if you have a 6% rate on a car, the Fed rate right now I think is 4.75, either 4.5 or 4.75, somewhere in there. Right. So you have a 6% rate, the car dealer isn't making all that.
No.
Right. The bank isn't making all of that. They're just making that little bit of a spread in the middle. Yeah. So I think that's important to note. Mortgages don't always follow it. They sometimes do. They sometimes don't. Right. And generally, right, if the Fed rate goes up, mortgage rates do too. But just because the Fed raises it by half a point doesn't mean mortgages go up half a point.
Nope.
So that's also important to differentiate there. And for those that don't know, Jerome Powell, Fed chair leader, whatever his proper term is.
Fed guy.
Yeah. for his position there, was talking that interest rates are going to have to go higher than expected. They were expecting to end at like 5.5. They're going to, he said, higher, possibly into the 6s.
And why do we think that is?
Inflation, unfortunately.
Because it's not doing anything right now.
Yeah, it's not.
Jobs are not being impacted because that's what they look for. They look for jobs being impacted. Mm-hmm. We are still at record unemployment, record low unemployment.
I think we're still under 4. I think we're like 3.5 or something like that for unemployment.
Normal is what, 5 or 6, I think, is what they look for. Around 5 or 6% unemployment. That's a nice piece to be at. We're still well under that.
Right.
And I can tell you we'll talk about in the spring market, nothing's changing in the housing market.
No, it's definitely not. But I saw a video, probably a week ago now, where he was getting questioned by Congress on whether he was going to raise rates, whether he was going to stay in pat. And he pretty much just told it straightforward, like, they're going
higher for longer.
Yeah, like they're going up. Yeah. And then Congress is like, well, you're going to put people out of work. He's like, yes.
That's the idea.
That's how we have to get out of that's how we unfortunately have to get out of this.
So much money out there.
Yeah.
They need to try and take it back.
Right.
Which is why they do this.
Right.
They're trying to take it back. Get it back. So people are either going to A, do nothing, or B, do something. Mm-hmm. And people are still doing something.
Yeah. Right. People are still borrowing money, and that's really where inflation comes in, is the amount of money that's borrowed and circulated. Yeah. When money is circulated, it's because it's borrow. Let's be very realistic. So we need to literally stop the borrowing at the end of the day. So when you raise rates, it is to essentially entice people not to buy anything. Yeah. And what you've seen from like Silicon Valley Bank and I think there's like 2 or 3 other banks that went under because their bonds were worth very little to nothing versus what they bought for. I don't want to say that's the goal, but that is unfortunately what happens when you try to tame a almost 10% inflation rate. Right? Like that's what you almost have to do, because you have to you got to bring those bond prices down, because the U.S. economy is very clearly not strong. So
and those are usually stable things to put in that were getting good returns for people.
Yep.
But yeah, it switched.
It just completely flipped.
Where now bonds are lower, and everything else is higher, and it's like, oh crap, what do we do now?
Right. Got to jack them up.
Come on in, Fed. Take it. Future Halloween store.
Right. Oh my God, that would be funny. Spirit Halloween or something.
Yeah. Sorry.
That's awesome. But yeah, no, so they were saying that has to go higher. Again, mortgage rates aren't necessarily going to rise because of that. We have our own opinion on what they're going to have to do to avoid, not a housing crash, but like a correction, like a very sizable correction. Favorable for buyers. If you want to look at it that way, they really can't move a whole lot, to be quite honest with you. Like I know my house has seen a pullback in value in Salem, which sounds crazy, but even though there's no inventory here, like my house has seen like a 5%, pullback, which is fine. I'm not stressing about it at all.
Well, and so it's tough. Like I'm gonna probably bump in here on that one. If you put it on the market, you would not see that 5%.
So that's fair, but based off of but that's
fair
because people would still compete and pay over for it. So that's fair.
What the algorithms see and how they generate, yes, I understand that. Like because that's all we can go by is automated value machines.
And I think that's a fair assessment.
Until you put it on the market and you get 40 people that are like, I want to move to Salem.
Correct, because there's only 6 listings in Salem, like that. So like, yes, the market will play its role, but like if I went to refi. I think is probably a better distinction. Like when the appraiser goes for the refi, that's where it would pull back. But like we're already seeing it now, and if we see rates go any higher, we're going to see it more and more and more. And that I can tell you is not the Fed's goal. As you learned from 2008, like the U.S. economy and global economy almost completely shot the bed because
they don't want to tank. They don't want to tank it, but they want to try and control it.
Correct, right. And like I've said it before, I'll keep saying it. It's the number one investment in their portfolio, in the government's portfolio, is mortgage-backed securities. So if you have a house, like they're going to do everything they can to make that the last resort to pull anything back. Like they'll hit credit cards, they'll hit you with cars, they'll hit you with all that beforehand.
It's one of their largest sectors for gross domestic product in the United States. It's like 25 or 30% of the GDP. Like, that's a sizable portion when you figure everything else that makes up the rest of that is smaller portion sizes.
And then for light at the end of the tunnel, housing does great in recessions. Right, housing is what gets us out of recessions. So for those that are like, oh my God, like I'm afraid like my house is gonna plummet, housing does amazing. Like that's what's gonna actually keep us moving through a recession is housing.
And if it does plummet, don't sell, hold it.
Right,
just hold onto it, because guess what happens after recessions? If things drop,
they go back up.
They go way back, and they go way back up.
Right.
We saw it every recession since like 1971. Even 1920. After a recession, they've gone right back up, and they've actually outpaced the previous high.
Right.
So 2008, everything tanked. Well, they've outpaced the pre-2008. So it's going to go up, and it'll go up higher than previously. So just hold on to it.
Yeah. So I think that's just important to note there. I think it's a really important touch point. I'm sure people know it, but it's just something really, really crucial that's happening in how it affects our world. Like our world gets affected by it, but it's not, direct correlation on that one. So pal, do your thing. Do what you got to do.
If it makes sense, buy it. If it makes sense, the monthly payment, whatever it is, put in an offer, compete with the other people and buy it.
So Rich, has anybody asked you about FHA 0% down? Has anyone ever brought that up to you or like asked you like buyer wise?
No, I love it. I love that. For the right people, for the right motivations, right? Like for the right thing. No, VA 0% down.
Right.
That's all I know for 0% down.
Correct. Right.
FHA 0%
FHA 0% down.
On what types? So you'll go into it. What types of properties and what types of buyer does that apply to?
Yep. So my understanding is it's just like a typical FHA loan. You can do it for 1 to 4 units. And then the type of buyer, personally, I think, your debt to income ratio needs to be lower, right? You can't go as high as a typical FHA loan. So you do need to be a little bit more of a qualified buyer. At the end of the day, you can go up to a 50% debt to income. At the end of the day, that's a lot of
you might
debt
not
to
want
your income. So, like, you don't need to be like this crazy, qualified buyer. It's a very typical FHA loan in that aspect.
Yeah.
There's 2 options for people for 0% down in terms of how the down payment is placed. So just like the last episode we talked about, it's a second lien on the property. Hey, remember that's every down payment assistance program is a second lien.
They'll put it on somewhere.
Right, right. So you can choose a 5-year or a 10-year quote unquote repayment option. Okay, so 5-year, 10-year. On a 5-year, it's it's at 0% interest. Right?
Perfect.
And then, but the first lien on the FHA loan is higher, right?
Gotcha.
So they hit you somewhere. So let's say an FHA,
so they'll make it back.
They make it back,
Yep.
right? So at the end of the day, right, an FHA loan is, say right now, like call it 6 to 6.5%. Like that first lien's probably going to be about 7.5 to 8%.
Sure.
Because you're getting a down payment for no
money out of pocket.
Yep. Or you choose the 10-year option, which has interest on it. But it's like your typical amortized over the 10 years. Over 10 years.
Okay.
Correct. So, if you're a $300,000 house, it's like, what would it be, 10.5, give or take, 10,500. As a second lien, over 10 years, over 120 payments, you're talking like $90 to $110 a month. Probably somewhere in there.
Yeah, like PMI, like private mortgage insurance.
It literally is like an added private mortgage insurance. That really is that's a really good way to think about it.
Yep.
And that has its own interest rate. So you'll still keep the bigger balance at your typical FHA rate at that time in the market.
Yeah.
That interest rate will be like 8 to 8.5%. Again, give or take right now. Just to give an example of where
your bigger loan has a lower payment, a lower interest rate.
Correct.
Fantastic.
Correct.
Your smaller loan has a higher payment. Okay.
Right.
Yep.
Right. And at that point, honestly, that would probably be the one I suggest. To be 100% honest with you, you want the bigger balance at the lowest possible.
Just factor it into your numbers.
That's
your monthly payment numbers.
Right. And just to understand how we qualify on it, right? We do have to take into account that second lien payment. So when we talk about that 50% debt to income, it needs to be that first lien plus the second lien. So that's just something important to note there too. But again, I don't want to say it's not self-explanatory, but that's really it, right? You can still get, closing cost credit. It's not like, you don't have that option. So literally you could buy a house for your EMD and then possibly get money back at closing. Like that's pretty much it.
So I know we've talked about this before too. What about self-sufficiency in relation to that?
Yeah. So self-sufficiency still relates
for
to
multifamily,
that.
For
the 3 to 4 units, self-sufficiency still relates because it is still an FHA insured loan.
Okay.
So that's still there. So that's a good point. That is important to note for 3 to 4 unit
for a 2-unit
properties.
duplex.
Yeah, exactly.
Right.
Like, that's the option for you.
Nice.
And it's one of those things too where I probably should have verified before. I don't believe, like, if you show you have the down payment in your account, I don't believe that matters. Like, for some of, like, New Hampshire housing programs, like, if you have too much assets in a bank account or somewhere, they won't take it because they're like, you're physically capable
of doing
it without completely draining everything that you own.
Yeah, that's a great question. I'd like to know that.
Yeah, so
because I have a strategy for this.
Right. So I probably should have confirmed that. I actually just thought about that in my head now.
Yeah. That's why we talk this stuff out.
Yeah. But if that's the case, like, so you could have, say, $40,000 in an account. If you don't want to put the down payment down, you don't have to, right? Yeah. And it's at that point, it's like VA. Like, you can be a millionaire with a VA loan. Yeah. They don't care. 0% down if you want to. Like, doesn't matter to them. Like, that's the loan.
Find that out and let me know.
Yeah, I definitely will. Because I want to know too, just because I'm curious for prospective buyers, because that would be amazing. Because then at least that point too, like, multifamilies usually call for some sort of reserves. You don't have to eat into that. Like, that could really help a lot.
You've got some options.
Right. Now you got options for sure.
Nice.
So yeah, no, I mean, FHA is 0% down. We just got access to it about a month ago, but again, that's because we switched over to CMG.
Awesome.
So that's, one more just kind of tool in our toolbox.
There's a lot of tools, like, and it's impossible for you to be like, here's like the 10 or 15 different options.
It's literally impossible. You would actually overwhelm the buyer.
Yeah, right.
You really
because
would.
Especially in the first few phone calls and conversations with them, like I don't get that.
Yeah,
like we understand it because we're working.
Right?
Yeah. So that's tough. Like how do you portray that or relay that, and even know that they might even want to consider that.
Yeah, and that's something honestly where I would bring up if they're asking about down payment assistance on the first call. That would be one that I bring up where it's like, okay, FHA has an option, New Hampshire Housing has an option. Are you a veteran? Like we would go through that. That's where that would be added in. If they're not specifically asking for down payment assistance or $0 down loans, I probably wouldn't bring it up until they start talking about FHA and we're like, well, what options do I have? Like, so there's a time and a place for the conversation because again, you don't want to overwhelm. You don't want to overwhelm the buyer with every possible option they have. And honestly, some buyers just aren't either qualified for it. It's just not the right program for them. And you just we can just talk them through that. Just like, every 3-2 house in, I don't know, Manchester, Auburn, Londonderry, like that's not for everyone. Like just because it's 3-bed, 2-bath doesn't mean that that's the house for you.
That's going to make it. Right. Exactly.
Right. And that's how I usually relay it to people too when they ask like, oh, what's every program you have for me? It's like, I could tell you that, but they would literally be like looking up New Hampshire 3-bed, 2-bath houses and looking at all of them. You'd be like, I don't know where I want to do here.
I don't want to be in Berlin. I don't want to be in Claremont. I don't want to be in Londonderry.
Exactly. Exactly. Yeah. So like, at that point, it's like, hold on, let me narrow in, what's the credit? What's the income? How much assets do you have? Where are you looking to buy? Are you a veteran? Like, let me get all this info. And then let's narrow this down to like 2 or 3 options. So that way you still have the options for you, but you're not completely swamped.
And it's so important to talk with a broker that's going to ask those questions and get those verifications so that you have a real number in which you can go shopping with. And you know that I'm talking about a specific buyer recently that had a number that was... looking at it as whoa, it was like really, because once you actually got the documents, because this previous lender didn't pull any documents or pull any credit scores or pull any of that stuff and ask for anything and gave them a number. If they got under contract with the property at that number, they wouldn't have been able to buy it.
There's no shot it would have been able to work. There really isn't.
So that sucks.
Yeah. Right.
They like the home of their dreams, right? The first home, the home of their dreams. Now you can't even buy it. So like you got to call Matt. You got to talk to him about and get the documents over. Like it might seem cumbersome, and it's not supposed to be easy.
Like a pain,
but it's not supposed to be easy, right? Like you're going to make it easy once you have all this stuff,
right?
But like, there's a little work that needs to be done.
Right. Yeah. And there was even something with, that specific buyer where yesterday I was even talking to him because there was something I noticed on the pay stubs. And I said, hey, I'm going to email you, 2 or 3 things over or in a secure email. Can you just send those back to me now? I literally said it. I know it may seem like a pain now that we keep going back and forth, but I'd rather have you do all this now than when you're under contract and you're worried about insurance and title and appraisals, inspections. Like, I don't want you to have to worry about that.
Let's do some legwork up front. That's what's been great.
Right.
Just get that legwork done up front.
Right. But the spring market, speaking of making sure everything, your ducks are in a row.
The one that started a month ago?
Yeah.
The spring market we're already in
we're already in
month and a half ago?
Yeah. It's here, people.
It's asinine.
It's here, and there is less inventory, and rates are in the 6s. And guess what? Buyers are freaking out because they need to buy a house. So for everyone that waited and said, 6% rates are going to deter people, and I'm going to wait for rates to come down, you should have bought between October and February of the last 4 months.
You should have bought something.
You really should have. It was the prime time to buy when there was no offers on houses, and okay, cool, you got a 7.5 rate maybe or a 7 rate. That stinks for the short term.
If you bought from June, July of last year till February, you would have been, even if it's 7%, you would have gotten a home. Right now, it's 6.5%. You put in an offer, you're competing 5 to 10 people.
Right.
A la 2020.
Yeah.
A la 2021
even, yeah.
Early 2022. We're in that market. We're in the pent up demand. So like how this kind of plays out is pent up demand from the winter. Buyers are shopping, buyers are looking, plus new buyers into the market because we're coming close to spring. All those buyers colliding with no inventory quite yet on the market, right?
Yep.
And in a no inventory market, like we're not going to have inventory for people to buy.
Right.
No one's going to sell if they've got a lower than 6.5% interest unless they need to.
Yep.
Death, divorce, and dependence.
Yep. That's it.
If any of those happen, then you'll see some sales.
Right.
But no one, like, people just bought and sold because they could, during low interest rates. Right. Now no one's going to sell. We've had a declining housing inventory market, right? There's a graph from CoreLogics that shows 2019 February sales. It was like homes for sale.
I did see this. Yes,
1,900 homes. Every year it's gone down. February of this year, we had 692 homes for sale. Went from 1,900 homes in 2019, a seller's market,
a profoundly seller's market,
to 697 homes in a 7% interest rate market, 6% interest rate market.
Yep.
Do you think it's going to go up?
Right.
Buy. If it makes sense, buy. And unfortunately, like we're going to go back to 2020 and 2021 language in our contracts. And, some buyers are going to be like, that's crazy. You're kidding me. Well, yeah, this is what we're in COVID craziness market.
Right. And not for nothing, we always like to pound our chest when we're right. Never when we're wrong. But when we're right, we've been telling people to buy literally all winter. Like this is the time to buy because it's before the craziness is happening.
Yeah.
You got to get over the interest rate. If interest rates drop to the 5s and we're at the inventory we have right now, the interest rate doesn't matter unless you get a house.
Right.
That is the only time in which the interest rate actually matters. So, okay, cool. Yeah, interest rates in the 7s seemed profoundly high. Like they seemed very, very high. And it's because they were.
Yep.
But you could get a house. So what would you take? Would you take a 7.5 that you can refi in 6 months when things come down, but be into a property, or take a 5.5 where you got to pay over appraised value and waive your next kid's life? Like, like what do you want? Like,
and I'm probably gonna say something that might offend people. If you just want to buy, like there's no need, sit on the sidelines.
Yeah, don't do it.
Because you're probably not going to be able to compete with the people that need to buy, that are willing to sell their child to buy a home.
To buy a home.
If I'm wrong, just comment now, tell me, call me. If I am wrong, other realtors out there, other lenders out there, if I am wrong, tell me. I want to buy in that market. I want my buyers to buy in whatever market that is. New Hampshire, obviously.
Right.
But if I'm wrong and you're seeing something different, tell me. Make a comment. Tell me that I am wrong, because I want my buyers to go to that market.
Right.
So maybe you don't want to tell me, but
Yeah, I mean, the southern New Hampshire market it's just ridiculous. Like what I told you about the offer that didn't get accepted from the last one, where it was essentially a waived appraisal and like 2-day inspections where the number they couldn't ask for repairs under like a ridiculous number, where essentially they waived the inspection unless the septic need to be redone. Right. Which, not for nothing, if you're selling a house and your septic's blown, you should probably fix that. You're selling your greatest asset, regardless.
And you probably maybe you wouldn't know, but maybe you would know, right? If it's bad.
But like it's bananas, and it's crazy too, because I'm seeing the very, very well qualified buyers that, $500,000, $600,000, $700,000 with 20% down can't find anything. Where the buyers first time buyers, maybe going into a condo, like all day. They're getting them all day. It's like, oh my God, from my perspective, it's like the first time buyers that were, squeaking into loans because they got student loans and credit cards and all these, car payments, and they're not making as much. Like they're finding a house all day long. But then the two W-2'd engineers that are putting 20% down and don't have a home sale contingency, and at $700,000, it's like, no, they just can't. They can't find any inventory, and when they do, there's 5 offers on it, and they're just
I've got buyers up to $1 million that keep getting beat out. 5 other offers. It's like we're looking at $700,000-$800,000 homes.
Yeah,
like this is crazy. But even my first time buyers, they're getting beat out. Couple offers. There is a market. sent a referral for a buyer in Berlin, New Hampshire, under contract in a week and a half.
There you go.
Beautiful.
For those that don't know where Berlin is, you gotta go north of the mountains. Yeah. You gotta go
just south of the Canadian border.
You can see Mount Washington from the north side.
Right. So yeah, I mean there are markets, right? Like, don't get me wrong, but like Southern New Hampshire are the core market here.
But I do. I mean, I was probably a little controversial, but I like it because it really is the case. Like, even like from our perspective, like if you're gonna get pre-approved, and you're gonna go through all of that, and go to listings and go to open houses. Like, if you love the house, buy the house. Yeah, like it may seem like you're paying a lot for it, but buy the house.
You'll regret it, and
don't try to find a deal.
You'll regret it in 3 to 5 years when that thing's worth more than what you would have bought it for, and the loan's been paid down, and you've got equity. It's scary. I get it.
Yeah,
I was a first-time buyer too. It's scary, but like it works out.
Yeah, it always does.
Just don't sell when it's down if you don't need to.
Right. If you don't have to. Like it's like stocks and retirement and all that. Like, if you're not going to retire soon, like don't pull out of your 401k just because the market's down 30%. It's not a good idea.
No, don't sell in the bottom to buy back in at the high.
Right. Yeah. And Mike, our old owner of PML, new sales manager of CMG, he'll tell people that all the time. Like when they freak out about the house market coming down, he goes, "What does it matter? Like, are you selling soon? Like,
your monthly payment doesn't change."
Right. He's like, "No, they're not selling soon." Like, what does it matter? It doesn't matter at all. Like, if you're going to be in the house for long, like this is just kind of like
just ride it out.
Right. Equity at the end of the day is just a number on a piece of paper. Yeah. Equity only matters if you need to pull from it or use it. That's the only time equity ever matters. Yeah, so it's like, okay, like if your equity goes down, is it annoying? Sure. Of course it is. Is it like, all right, that stinks, but like you're not going to sell, you're not going to refi. You don't need the equity to refi.
Right.
We're fine. Everything's totally fine. You just live your life as normal and everything's good there. Oh, but what would you, to end, what would you say like your, tips for buyers maybe in this market where it can seem daunting, where rates are higher and inventory's low and this competition's up again? Like, what are you telling buyers now to maybe keep them motivated or just kind of keep them, looking?
Yeah. So it's just going to be a numbers game, from the onset. Hey, listen, we're going to do this process. It's going to be cumbersome. I will give you I will give you advice on what wins the offer. You might, and I'll tell them you're probably not going to like this, but this is what would win the offer. Let's do something between, maybe there is the top barometer and come down, whatever you're comfortable with, right? But let's be consistent, right? Don't get emotional on a lot of these homes. Yes, these first homes and primary residences can be emotional, but don't be as emotional. Don't get too tied into it yet.
Yeah. And that's just, and not to butt in, but that's just a good agent in general, right? Like you being able to sit there and be like, hey, this is realistically the number or the terms that it's going to take. Are you willing to do it?
Right.
Because then at least that way you're just being honest with your clients, which sounds very self-explanatory, but not a lot of people do, right? They're just be like, oh, what do you want to put in for an offer? Right, you tell me, and yes, you're ultimately telling me and Rich what the offer is going to be. But Rich can sit there and be like, all right, on this, I don't know, $400,000 house, it's looking like really comps are showing 430. You may want to go like 440, 445. And then at least if you're comfortable doing it or not, and it's just like, okay, like I can now make a decision.
And whether there are comps are there or not, we already dealt with this scenario during
COVID. We know what to do.
Is that comps don't matter. It's what someone else is willing to do.
Yeah.
So escalation clause up to a certain amount, like, if you've got a high number that you're good with, that might be the winning number. But it also might not be.
Right.
Because we got to look at terms. The number only matters a certain amount. You want $400,000 house, you can offer $500,000. It's not going to appraise at $500,000, very likely.
Right. So what does your appraisal language look like?
So there's a lot of different. I like to call it the gray.
Right.
It's not black and white. We have some gray in here. There are certain pieces of the contract that are black and white, but we have some gray that we need to deal with too. So let's talk about the gray. That type of thing. That's the conversations I have.
Right. I think that's just really, really good advice in general. And just important again for people to know and understand that, like, agents will tell you. Good agents will just flat out tell you where they think it needs to be. And if not, cool, let's go find another one. Yep. Let's find another house then.
Or put in the offer, no problem. Like if it's not that max, that craziness that is probably going to take it, that's okay. Let's still do it because you never know.
Yep.
But we're going to put that one in. But let's keep looking.
Right.
Just like we did during the COVID craziness.
Right.
We're going to still look at like 3 open houses this weekend.
Right.
We're still going to look at 2 listings this week.
Right.
You know, yeah, you've got an offer in, but we're still looking.
Yeah.
If you find another one and your offer hasn't been accepted and, you know, maybe the timing works out where that one doesn't get accepted or it does and we haven't done this next one, great, no problem. But we got to keep looking.
Right.
Keep looking. Keep looking.
Right. It's literally almost like a numbers game at this point. Like, even though there's not a lot of numbers out there, like it's a numbers game. And, you know, how many can you look
Increase
at?
Your odds.
Right. Right. That you genuinely like. Don't just throw in an offer to throw an offer in. That, like I'm experiencing, don't throw an offer just to throw it in. Make sure that, you know, you would be good if it appraised at that number, and make sure that, you know, you're good with the payment and everything works at that number. Because God forbid, you don't know, right? Comps, maybe we're not seeing it, but appraisers are looking at it and we're like, well, we're going to add value to the comps because, you know, your house has X, Y, and Z. And we're like, oh, okay, maybe the house, like, that is worth it. The comps are showing 20 grand less, but you have 200 square feet more, and appraisers are like, no, that's because that's what they do. All right, that's close enough. We'll give it to them. Like,
and let's remember, appraisals are opinions of value. Get 4 appraisals on the same house in the same day. They're all going to be different. I'm sorry, appraisers. And I'm sorry people that don't know that and maybe think I'm lying.
Right.
Do it.
That is the truth. It's
opinions of value. Right. So can their opinion of the value based upon 5, you know, offers roughly around the same price point? Well, yeah, their opinion of value could be that is okay.
Right.
If it's not, well, guess what? We can call another appraiser and probably get a different appraisal.
Right. Right.
They just need to be able to back it up on their paperwork.
Exactly.
That's all.
Exactly. Right. Or, you know, reconsider. You can always do reconsiderations. There's a lot you can do. Yeah. But yeah, no, that's like a lot of the updates we have. I thought that was awesome to run through 3 things at once. That was
fantastic.
That was nice to kind of dive through everything there. If you guys have questions about the FHA 0% down, you know, let me know. I'll walk you through everything. You know, I'll be able to pull up everything. So every specific scenarios that we can't really dive into on a podcast, for every single person. You know, let me know. I'll tell you if it's a fit for you or if it's not a fit. And I'll just be honest with you because that's what I like to do.
Yeah.
Right? I like just telling you yes or no because that's the reality of the situation. The numbers don't lie.
Should they email you?
Yeah. You can email me at mmacdonald, so 2 M's at the beginning. I always have to specify that. McDonald at cmghomeloans.com. My number is 603-475-5471 if you want to call me or text me. I'm always on my phone, so
I hear you there.
Either way, either way it works. I always joke with people that like I'm a young mortgage guy, so like they text me at like 8:30 at night. Like people are always like, "I'm so sorry to bother you." It's like I'm on Instagram. Like I'm on my phone.
Right now.
I'm a 25-year-old mortgage guy. Like I live on this.
Yeah.
Thing.
Oh yeah.
So
no doubt.
But where can they reach you? Yeah, you, Rich.
Yep. Rich at RacineRealtyTeam.com and go check out www.findnhomesforsale.com. We've got a new listing right now in Derry under 400,000, 3-bed, 1.5 bath.
Nice.
Got to check that out.
Under 400K in Derry is pretty good.
Yeah, it's not going to last.
No, it's not. It's not.
It's a really great, and it is like mint.
Nice.
Really nice.
Nice.
So come check it out. We got the private showings you can schedule and open houses if you want to go to that this weekend.
Yeah. Awesome. Well, guys, if you need anything, reach out to us. As always, drop a comment. Make sure, you tell us what you want to hear, what you don't want to hear.
Yeah.
We're always open for feedback. And that, for the 31st time, is why money matters.